So I get asked a lot about best practices with working with banks, primarily because I was in banking for about 10 years before I started my real estate company and then started kind of expanding from residential into commercial and kind of making that adjustment. So I've had a good amount of interactions with banks. 10 years I was with them, and then for the last 12 years or so, I've been kind of off on my own working with banks to get debt. And we work with banks quite a bit on a lot of our projects, especially ones that we're trying to buy at a discount, add value before we either take it to term market or look for long-term fixed rate debt options, right? So, but when working with banks, it's very, very good to one, kind of get an analysis of the area, right? The market that you're in. I'm in St. Louis. St. Louis is a lot of banks, so it works for a lot of good opportunity on that side, but more so than anything, it's understanding which banks like to lend on what type of assets, right? So that plays just a really, really big role. So there are certain banks in our market that are very friendly when working on residential investment deals, single families, 2 families, 4 families. Like, they work with that sector really well, and you can get good financing terms, you can keep your fees down and come up with really good options on that front. And then there are some banks that just don't want to do that kind of asset class at all. But for now, we'll talk about kind of multifamily into commercial on that side. So what I typically do is I find out the banks that, one, work with the asset class that you're trying to work with, two, have the obviously best rate and term. So more times than not, credit unions often have the best interest rates and best financing terms. For the longest time, credit unions couldn't finance commercial deals. And then there was some kind of legal change that occurred in the last 5 or 6, 7 years that kind of changed that. And now credit unions can now lend to commercial deals, but they oftentimes don't have commercial lenders or back offices that can handle commercial deals appropriately. So you got to find what are the best ones that fit that on the rate and term model, and then actually can underwrite and work those deals, and it's not going to be too complicated for them. But when you can put those specifics together, you can get to a really, really good spot where you can get interest rates that are maybe 1.5% or 2% below what the market is for similar banks in the area. And you can oftentimes get longer loan terms. Like, for example, there is a credit union in town. Their total asset mix is about $1.5 billion in assets and 750,000. So half of their loan mix is car loans. So this is a credit union, keep in mind. So once they started getting into commercial deals, they were totally comfortable doing commercial construction to term loans that were 7 to 10 year loan terms at really attractive interest rates. So if you can kind of work through that model and try and figure out what banks can work or what credit unions can work with the right type of assets, you can really kind of come across some really lucrative ways to look at it. So beyond figuring out which banks work for the best asset type and then which ones provide the best rate and term for the loans, and then the ability to actually underwrite the deals and make them work properly, so then you have to say, well, what are the banks going to want? And what makes it so that they can make a decision quickly on the deals that you're bringing to them? And when you think about it, right, more times than not, bankers get a lot of loan requests and they're dealing with a lot of different folks. So you almost have to look at it. Back in the day when banks were doing short sales and moving things like that, you had to make your short sale package look the most attractive and the most complete so that it would go to the top of the stack because it was the easiest to move forward. So that's exactly how I look at it when I want to bring a package to a bank. So the easiest way to do that is have 2 or 3 years of your personal and any company tax returns that are completed, have those in a file. Hopefully it's a secure file, but whatever it would be, so it's just ready to go. In addition to that, have a personal financial statement fully filled out. If you need help with that or need one of those, comment below. I can send that to you. But you have your personal financial statement and your tax returns all completed in a package, in a file that you can immediately send to them or ask them for a secure email link that you can put into their portal. That way, they have all of the kind of personal and company financial information that they might need to underwrite that property well in advance. So the banks that you've identified to work with, they already have all of that. So they can get a really good idea if you would be a good client for their bank or not without even having the property that they're going to evaluate. So once they have that information, now as you're evaluating deals and you're coming up and trying to talk to them about different deals that you might want to purchase and finance, now they already have all your personal stuff, all of your company stuff, and your personal financial statement. Now they're only looking at the deal. So now once you've done that, now you want to do a really good good financial analysis on the property. You're probably already doing that for your back of the envelope analysis to know if it's a good deal or not. But from that point, you want to have a simple breakdown that has like a cover sheet that says, hey, here's the purchase price of the asset. Here are the improvements that I'm going to do. Here's the soft costs or the holding costs and different expenses associated with getting that property to completion. And here's my all-in cost for that property. Here's what it will be worth once it's all said and done. And then what amount of equity are you capturing as a result of doing those repairs? Cool. Below that, you would have on the summary sheet, you would have what is the revenue and the net operating income of that property, and then what's the debt service coverage. So if you assume a simple interest rate and term for that loan, you can determine what your debt service is going to be pretty easily based on the NOI and the cost of the debt. That's what the banks are going to be looking at. And then you can have just a little breakdown of what the property is. If it's a 20-unit apartment building, you'd have 20 units, bed bath count, cool. Then if there's garage spaces, any of that, size of the lot. Now they have all of the analysis they need on one simple page. And then from that, you have your sub pages of your analysis report. You'd have your revenue model and your underwriting, where the NOI and the excess cash flow and debt service coverage is on a full breakdown. You would then have what's called a sources and uses table, which is the uses of the money that we've already just talked about on the cover sheet. And then how are you going to source that? Are they going to require 20% equity? Cool. So the debt's going to be 80%, equity is going to be 20%, and then are you going to bring that in from outside parties or are you funding that? Little source and uses table, it's almost like a balance sheet. And then you would have your rent roll for that property so they can see what each tenant is paying and what their lease term is. And then next to it, you would have what the pro forma lease rate is and whatever the term would be. You know, if you're dealing with properties that would have a longer than a 1 or 2 year lease term, you know, if it's commercial, you might have 5-year term or whatever it might be. So you'd have all of that evaluated in one simple little package. You probably are already doing all this analysis, but it puts it together in a bank package so they can immediately already have all of your personal information and then now a really good summary of all of what the property analysis is going to be so that they can immediately start on second base and get that deal and know about what they would require and what kind of lease terms or what kind of loan terms they can give you, but then also have a much better idea of the likelihood that it can get approved. If it's a small enough loan, sub $1 million in most instances, a lot of local banks can either just the lender that you're dealing with and their boss can sign off on it, or in some instances it has to go to a loan committee. But the more information that you can get to them, the faster they can put that package together to get to their approval so you can know whether you have a deal or not and be able to kind of move forward on that property. So one, just get it approved faster and know what the exact terms are sooner. Get all of that completed in your due diligence period. So that's the best way that I find to work with banks. When I was a banker, that's what I like to see, and that's what we provide banks, and it really, really makes that process more efficient and allows us to get the best terms from the banks we're working with.